If you earn above £120,000 a year, there is a very good chance HMRC is taking thousands of pounds from you every year that you could legally keep. Not because you are doing anything wrong, not because you have made a mistake, because nobody ever showed you the rules that change once your income crosses this level. The rules that apply to someone earning 100,000 do not apply here. The mechanisms are different, the priorities are different, and the cost of not knowing, the cost of carrying on with the same approach, runs to tens of thousands of pounds over a career. That ends today. My name is Mark. This is Wealth Architecture. And if you earn above 120,000, this video was made for you. Let me start with a number most people at this income level have never been shown. By the time your income reaches £120,000, your personal allowance is almost entirely gone. At £125,140, it disappears completely. What that means in practice, every pound you earn above £125,140 is taxed at 45%. And in the band between £100,000 and £125,140, the taper zone, your effective marginal rate isn't 40%, it is 60%. Effective tax rates 2026/27. £100,000 to £125,140, 60% effective rate, taper zone. Above £125,140, 45% additional rate, allowance gone. These numbers are not contested, they are not loopholes, they are the UK tax system. The question is not whether this rate exists, the question is, why has nobody sat down with you and explained what you can do about it? There are 4 mechanisms available to you at this income level that are not available, or not relevant, at lower incomes. I'm going to go through each one. Lever 1. Pension contributions at 45% relief. The pension annual allowance is £60,000. At 150,000 income, maximising contributions produces 45% relief on every pound. A £60,000 pension contribution costs £33,000 after relief. The remaining £27,000 belongs to your pension from day 1, not day 2, day 1. If you have carry forward from prior years, unused allowance from the last 3 tax years, your available contribution this year could be substantially higher than £60,000. Lever 2. Salary sacrifice across the full band. At this income level, salary sacrifice doesn't just reduce your adjusted net income. It reduces the amount of your income taxable at 45%. The combination of 45% income tax relief and 2% national insurance saving means the effective relief on salary sacrificed above the additional rate threshold approaches 47%. That is not a rounding error. Over a career, that difference is material. Lever 3. Spousal income equalization. If your partner has a lower income or no income, investment income from jointly held assets uses their tax allowances and lower rate bands. This is not artificial income splitting, it is structuring asset ownership in a way that reflects legal entitlement. If one partner is a basic rate taxpayer and the other is additional rate, the annual saving on investment income can be substantial. Lever 4. VCTs and EIS. Venture capital trusts offer 30% income tax relief on qualifying investments up to £200,000 per year. Enterprise investment scheme investments offer 50%. Both carry significant risk and are suited only to those with a solid base of conventional assets already in place. But they are legitimate HMRC-approved tools for income above what pension and ISA wrappers can absorb. Let me show you what this actually looks like. Meet Natasha, 48, Managing Director. Income this year, £160,000. She has never used carry forward. Her employer makes pension contributions of £8,000 on her behalf. She came to me wanting to understand her optimal structure. Starting position, adjusted net income before any personal contributions is £160,000. She is paying 45% on everything above £125,000, £140,000. Her pension annual allowance is £60,000, minus the £8,000 from her employer, leaving £52,000 of personal contribution available. Gross income, £160,000. Employer pension contribution, £8,000. Available personal contribution, £52,000. Cost after 45% relief, £28,600. ANI after contributions, £108,000. Personal allowance restored, £6,430, partial. Estimated tax with planning, £38,000, approx. Estimated tax without planning, £58,000, approximately. Annual saving, £20,000, approximately. £20,000 every single year. Not from a scheme, not from avoidance, not from anything clever or unusual or aggressive. From using the structures that HMRC built into the system. Structures that exist precisely because Parliament decided that pension saving should be incentivised at this income level. That £20,000 goes into Natasha's pension, where it compounds tax-free until she retires. The question isn't whether this is available to you. It is. The question is whether you've been using it. I want to say something that most financial content never says directly. Above $120,000, the tax system doesn't become more complicated. It becomes more consequential. The same principles apply. The sums are larger. And the decisions, made or not made, have bigger effects. At $90,000, a planning mistake costs you hundreds. At $160,000, the same mistake costs you thousands. At $250,000, it costs you tens of thousands every year without announcing itself. The system doesn't reward effort. It doesn't reward long hours or a good employer or a strong salary negotiation. It rewards understanding. And understanding, unlike effort, is something you can acquire in an afternoon. That is what this channel is for. 3 things to act on before this tax year ends. 1. Calculate the gap between your current pension contributions and your annual allowance. Include what your employer contributes. Include carry forward from the previous 3 tax years if you have unused allowance. At 45% relief, filling that gap is the highest returning financial decision available to you. Not the best investment you can find, not a better savings rate. The highest returning financial decision. Full stop. 2. Check whether salary sacrifice is set up at your current income level. At 45% plus the NI saving, the effective relief approaches 47%. If it isn't set up, one conversation with your payroll department changes that. 3. Look at any investment income sitting outside your ISA and pension wrappers. At 45%, that income is expensive. Moving it into wrappers isn't complicated. It's a decision. At £120,000 plus, the priority order is 1. Employer pension match. Always take it fully. 2. Salary sacrifice to annual allowance limit. 3. Personal pension contribution to fill remaining allowance. 4. Carry forward from prior years if available. 5. ISA for accessible savings. 6. Investment income into wrappers where possible. In that order, every year, without exception. In the next video, a trap that catches people at every income level if they have children. A completely different kind of 60% effective tax rate, one that sits between £60,000 and £80,000 and affects families who have never heard of it. If you have children, and your income is anywhere near that range, or if you know someone who does, the next video is not optional. Subscribe and bring someone who earns above £120,000 with you. See you in the next one.